Returns probably can't stay as high as they have
further
the last
assets
few
bought
years.
at the right time.
Not only
Various
stable
stable
trusts,
trusts. Things that are in control. The biggest
fragmented
challenge is to find the right people.
Pre-tax profit for the 6 months to September 30, down by a third compared to this time last year. Why such a fall?
Well, that's stripping out tax and going to the real issues. What we have done is to change the whole portfolio from a more stable and structured portfolio to a much more nimble type of operation with more trading profits, more trading stock rather than investment stock to prepare for what's been a bit of a crisis and what I think is going to continue to be a crisis in our world for the next 6-9 months at least. So in doing that, we have more lumpy results. You get a planning consent, you don't know when it's going to happen, it's going to be in your first half, second half, so we have to live with that. And for the next few years, we are going to have more lumpy results coming through. Down a bit, up a bit. The actual timing of them is very difficult to actually maintain or indeed allow for. So a lot of it is less in the first half than I'd like. Hopefully, one can only say, more in the second half to make up for it.
More in the second half, but you still believe the next 6 months will be challenging?
The next 6 months, 9 months, probably a year is going to be challenging to all of us. But some of us have got ready for it. We've got our speedos on, so to speak, whereas everyone's still going around in suits of armour trying to sort of fight off the attacks. But it's not quite as bad as that. But the next 6 months for us are going to be as good, if not better, and therefore we will make up that particular deficit in the next 6 months, hopefully the second half of our year.
You'll be moving into slightly more defensive assets. What type of assets will they be?
Well, it's not so much defensive. I mean, to prepare yourself in advance for a reduction in valuations, which is the real case. We're saying 10 to 15% is the real deduction in the market valuation of real estate. And the sooner the market sorts that out, the better. We're hoping it'll be quick and painful, but let's get it out. And then we all know where we are. We can start rebuilding, and we particularly can start with our buying boots on again, which is what we would want to and be looking forward to do. To get ourselves prepared for this situation, we have, yes, a defensive situation, like we have cash, and we have an offensive situation, like the next few years, we are spread into different types of property that are, I would call them defensive. It's no accident we haven't got a major city speculative building in build. You don't want one right now. It's no accident that we don't have lots of out-of-town retail parks around the country. Both of those types of business were our main business in the past. But it's no accident we haven't got it at the moment. You don't want them, because that's where the major pain is being felt. City and out-of-town retail parks. Interesting. So we ain't there. What we have, going back to this offensive stance, is we have this spread, student accommodation, lots of planning changes, going through industrial sales to owner-occupiers all over the country. And on that basis, retirement villages, on that basis, we're going to do very well and outperform, because those are the sort of things that are least affected by things like credit crunches and a reduction in big values.
Offices are still a significant part of your portfolio, I think 30 to 40% of your investment portfolio. Will you be reducing that proportion over the next year or two?
No, well, funnily enough, we're about 38% offices in central London. Funnily enough, that's been reduced down to that level, and we don't want to go any lower than that. Now, you will find us, over the next year, building that back up again. You know, it's all about riding the troughs and highs. So you're coming out of it so that the valuations don't hurt you too badly, because you're anticipating, in this case, a drop in value. Once that's happened, you're going to be back in the market, building it back up again, because what will follow a drop is a rise. So there's a fluid situation on offices, and I think you'll find we will start building and buying offices, sort of Clerkenwell Wells, Southwark, Shepherd's Bush areas, these sort of villages around the core, and West End, villages around the core, and that's where we will be working now to try and build that back up again.
Indeed, you announced this week a joint venture with UK Coal for a government office campus up in Sheffield. Are those the type of ventures you'll be into?
Yes, well, offices are not the big thing to be doing at the moment, but you look at that marketplace and you say, okay, who are going to be the main occupiers of new offices in the regions over the next few years? And it's probably government. I don't want to take too long talking about this government issue because I could wax lyrical for a long time. We've been doing it for a year at least now. And setting up major government-dedicated campuses for the government's rationalisation that's going on, and the National Audit boys came out today with a criticism of a government estate as being inefficient, and they've got to really get their grips on what Michael Lyons tried to do and what Varney's carried on with. So we're behind all that. So hence UK Coal, large site in Sheffield. We'll pull it down as the pre-lets come in. We've got equally a scheme going with Keele University on the northwestern side and a major project in Newport in South Wales, all for dedicated government estates. So come back to offices. No, you don't really want offices right now, certainly in the city. Don't mind West End, but certainly in the provinces, no. But there's a game here, and that's our job. Over the next 2 or 3 years, if we can roll out to government, we'll do very nicely, thank you.
Just one question on actual development. We had Ken Livingston last month lifting his objections to your joint venture industrial scheme in Southall, citing environmental efficiency or the lack of it in the initial scheme. Are you having to change sort of development practices to meet that sort of green agenda?
Yes, we do, and hence building costs rise. Now, that's fine. But if you had the site and you'd bought it a year ago and you've suddenly got to put wind turbines on your roof and you've got to do all sorts of recablings and all sorts of environmental things that are now thrust upon you which you didn't know you were going to have to bear, that scheme's gone out the window. So there's a balance here, isn't there? And you mentioned the scheme in Southall, quite minor changes, but they're all perfectly sensible, all perfectly good, and we're very happy with that. We are as green, and we've got to be as green as the next guy. I don't think we have to compete to be greener than the next guy, but we have to take this aboard. The only problem does come when you haven't actually bid on something, taking that into account because it's then been thrust upon you, then you do have a slight problem with it. The scheme in Southall is not affected in the slightest. It's quite minor stuff, and actually we're quite grateful for that lead from the GLA on that.
But is there any clear practices or protocols in place for you to follow to make sure that you don't run into that sort of problem?
It changes all the time, and a political gains can be made by coming out with more green and environmental situations and loading the industry with them. It's settled down. We do know now there is a code established as to what has to happen, and it's taken a while to actually sort that out. And as I say, we quite welcome it. But for city schemes in particular, there's been quite a load on costs, and that's taking time and will cause some pain on current schemes in the city because they have been loaded with quite extensive costs. So that's something that happens. And if you're in the right place, fine. If you're in the wrong place, tough. You've just got to live with it.
Just a question on Helical Bar's structure itself. We've seen an interesting announcement from Land Securities over the past couple of weeks. How does Helical Bar feel about the way it operates in the marketplace? Does it need to change structurally for the challenges ahead?
No, we don't. And we're not a REIT. Not like Quintain and St Modwyn's. I mean, we're trader developers. We're not investment stock. And a REIT is an income-led investment vehicle, as I think the big boys are now finding out. This is a bruising experience for them. When they went into this last year, it was all going to be, we can stay multi-sectored, we can be multitasking, we all decide what sectors to be in. And, Lands have now suddenly said, maybe that ain't working too well, let's split ourselves up. Personally, I think it's a shame, because that was a major bellwether of the industry. And there's an element of nostalgia, actually, about Landsex. I would prefer it not to be broken up. I think it's a shame. But in terms of if you are a REIT, actually, at the end of the day, that's what you're going to have to do. So their decision to become a REIT was made. Their experience has now led them to actually this situation. At one stage or other, British Land and the others will all have to follow, but not yet. So a very interesting play. As far as we're concerned, we watch this from afar. We have our shareholders, and our shareholders trust us to be nimble and move within sectors. And if you do that, you're going to be a better performer. So that's us. We can't be a REIT. And frankly, I wouldn't want to be a REIT.